Good morning, everyone. I'm Ann Koontz, and I'm here with my partners, Jackie Durham and Marina Parkin, and we're back with more PPP fun. If you didn't get enough of it in 2020, we're back starting out the year with a bang with more. So as you might be aware, there was some new regulations that were issued, of course, right at the holiday, as they like to do. So we've had some time to digest those and go through those, and we wanted to bring that first round of PPP information to you. We're going to continue to do this because, of course, there's too much to do just today. And we will focus separately on the second round of PPP, the second draw. Then we'll talk about the forgiveness, and then we'll talk separately in another webinar as well about the tax changes. So we'll reference those things and let you know we'll have those coming up as well. So as always, our webinars are recorded and available for you to revisit in case once wasn't enough, and because it's so fun. So you can go to our websites, Koontzassociates.com, KoontzParkin.com, and find all of our recordings there. You can also go to our YouTube channel and to our Facebook pages. So if you have any questions, please do put them in the chat box or in the Q&A box. It's a little bit easier for us to monitor than they are in the chat box. So without further ado, Jackie, the guru of all things PPP, all of your enthusiasts are waiting with bated breath. What's new?
Well, as Joanne mentioned, we are going to kind of on a higher level go over the new PPP loan requirements and terms and restrictions, mainly as they apply to second draw PPP loans, because most of our viewers and clients have already taken out a PPP loan and they're trying to determine whether or not they're eligible for this second bite at the apple. So we're going to kind of focus on that. But I do want to mention that if you have not taken out a PPP loan yet, and you're interested in doing so now under the new rules, and you're interested in that, we also, you can email us and ask us questions, and I can guide you to the best extent I can on the new regulations as they stand today. There are going to be additional regulations coming out in the future that are going to specifically discuss forgiveness. There's going to be some old rules that are still in place, and there's going to be some new rules that are coming in under the Act. So I do want to mention that we'll touch on that later in the webinar, but we're not going to do a deep dive into that today. And the slides that you'll see will have a lot of information on them. And I'm putting that there just in case viewers want to go back and double check something that applies to them in particular. And of course, we're always available for questions via email after the webinar. So I will go ahead and put our slideshow up. The first thing we want to touch on before we dive into the specific provisions of the new Act as they pertain to second draw PPP loans is the simplified application. Everyone's been waiting on this one-page application that everyone was hoping would get passed with the new law, and this makes it more simple for these PPP borrowers to request forgiveness. It includes limited information about the amount you borrowed, the amount you're entitled to be forgiven, your number of employees, things like that. But I think there's a misconception surrounding this simplified application that because it's under $150,000, in terms of its eligibility, you have to have your loan under $150,000 to file this one-page application. A lot of folks think that they don't have to necessarily answer to this application later. And that's not the case. We've been seeing more and more PPP borrowers, both small borrowers and large borrowers, that have been called into question in terms of not only their forgiveness applications, but their initial loan applications. So you want to make sure, even if you qualify to file this simplified forgiveness application, you need to still do the backup work to get to the accurate numbers that you're including on the application. So there's certain backup documentation that you're going to need to retain for your records. I would keep that organized in a folder on your computer, along with any documentation that you use to reach the numbers that you're including on the application itself. We also, just to be safe, if you want to go ahead and complete the long application to demonstrate how you're getting to these numbers, that also is probably in your best interest. Even though it's going to be a little bit of an exercise, at least you can go back to that if anybody comes to you with questions about how you got to the particular amounts you're listing on that short form application, because it can happen. So just wanted to raise my hand about that. The other thing I want to mention is PPP borrowers, particularly those who received their loans but may not have even filed for forgiveness yet. They are being audited under certain circumstances, and I really don't know what is triggering the audit, and I guess it really doesn't matter. But you need to be prepared to explain your need for the loan and that necessity certification that you made when you took the loan. One of the forms that I recommend that most of our clients complete just to have in their file in case they are questioned later about their eligibility for the first PPP loan is Form 3509, which directly addresses loan necessity. It's about 10 pages. It's not going to be a fun exercise, but all of this information is fresh in your mind now. And so what I recommend is completing not only this form, but also documenting, like Marina and Joanne and I have guided you in the past, documenting sort of where your head was at the time you made the first loan application, because there was a lot of economic uncertainty at that time. So you really want to, while you still recall what was going through your head, you need to document why you felt that this loan was necessary for you and why you felt that there was economic uncertainty for your particular business. Because if they come to you in 2 years, it's going to be a little more difficult to explain that. And the Form 3509, which we will include with the slides after the webinar concludes, it's just going to be something nice to have in your file, because if SBA does come asking questions about your eligibility for the first draw loan, and whether or not you met the requirements and whether or not you calculated your loan amount properly, this is going to give you that backup information, and it won't require so much legwork on the back end in a year or so.
And I have to jump in here to say that it's particularly important to do this now because a lot of businesses have recovered very nicely and have made money. I mean, a lot of industries were impacted in a positive way where their sales were up and their activities were up. So even if you're looking at a year in question, you may have been completely shut down the first 2-3 months, during the pandemic time, and then once you open, you've recovered well. So when you're looking at your year overall, you may actually be up in your revenues. And so if you were one of those first draw borrowers back in the day, you still need to make sure and go back and you have that documented. If your business is still suffering, please document the second draw right now, because it is just incredible. We have, I believe there's about 6 or 7 years or so in which SBA can come back and audit you and question this. And to be honest with you, we're not sure what exactly is going to trigger this audit. They specifically said that, the under $2 million loans, they're not going to audit on purpose. So not every single loan is going to be picked up, but there's going to be other triggers. For example, what I can see happening is the IRS is going to be a big agent in this process. So you submit your tax return, it may be randomly picked up where maybe your income is higher than in the past years, or where you've recovered nicely. There's no reason why IRS cannot notify SBA that this may be a particularly good SBA audit candidate as to did they really need the loan. And so because of that, you don't know exactly where that audit is going to come from, and documenting these requirements is key.
The other aspect of the audit that can come into play is not just auditing whether you were actually eligible for the loan, but then auditing your eligibility for the forgiveness. So the documentation needs to be squared on all angles, and the more you chew through those longer form applications, the more you can ferret out any inaccuracies or mistakes or oversights that you might have. So that's just a good thing to have ready to go, because it is confusing. It's confusing to us, and we do it every day. Imagine if this is just the one time you're touching it, it's super easy to misconstrue something or include a number that isn't appropriate.
Right. I mean, Marina and I had fun practicing with the long forgiveness forms, and it's amazing where you think a situation is pretty relatively simple and straightforward, but unless you go through the exercise, you don't always necessarily get to that correct amount on your forgiveness application. So it's also just covering yourself to make sure what you're putting on that short form forgiveness application is accurate and correct, because you're certifying that it is. And the lender's certainly not going to do your math homework for you. You're responsible for that. So
His favorite line, the devil's in the details.
Same.
So the general terms for these second draw loans, which is, basically you're gonna have a second draw loan if you've already taken a PPP loan. What I also want to clarify is some people are saying, oh, well, the new act says that I can take multiple loans. That's not exactly true. If you received a first draw PPP loan last year before this new act was passed, and then under the new laws of this act, you can increase your loan, or you can now go back and re-request a PPP loan that you repaid or return. That's what people are talking about. You really only get one full PPP first draw loan and one full PPP second draw loan. So just want to clarify that. The second draw loans are going to be similar to the first ones. They're 100% guaranteed by SBA. There's no collateral required, no personal guarantees. We're still at the 1% interest rate. The new law clarified that this is non-compounding and non-adjustable. The maturity date is staying at 5 years. And for now, the loan program is going to remain open until March 31st. So the new act sort of expanded who was eligible for a PPP loan. I don't think that most of these organizations really fall within the realm of our clients, so I'm not going to dive into them. There are certain nonprofits and tribal concerns and things like that, so I'm not going to touch on that. We're going to focus mainly on small businesses, independent contractors, self-employed individuals, and sole proprietors. So if you're one of those folks and you're interested in a second draw PPP loan, you're going to have to satisfy the following eligibility as sort of your first hurdle. The first requirement is that you used your first loan in accordance with the loan terms, which I'm sure everyone did. You also have to have used up your first draw PPP loan in its entirety, or at least you suspect that you will by the time you receive your second PPP loan. You, together with your affiliates, are not more than 300 employees. I don't think that's really going to affect any of our viewers today. There are certain exceptions for those in the food service and hotel industries, but I don't really feel like anyone who's watching is going to breach that 300 cap. The next one, which has been talked about a lot, is the 25% reduction in revenue requirement. So there's a few different ways that you can measure this. You have to show that you had a reduction in revenue from 2019 to 2020, and you basically compare that on a quarter-to-quarter basis, but it has to be the same calendar quarter. So if you were in operation for all of 2019, you can pick any quarter in 2019 and compare it against the same quarter in 2020 to show that 25% reduction in gross receipts. Now, if you weren't in business for all of 2019, let's say you weren't in business the first 2 quarters, you can pluck either your third or fourth quarter of 2019 and compare it at any of the 4 quarters in 2020. Same thing goes for if you were only in operation for the final quarter of 2019. You can basically compare it to any of the 4 quarters in 2020, which is nice. It gives you a little flexibility there. Now, if you were not in operation at all in 2019, but you were in operation as of February 15th of 2020, you're going to compare that first quarter of 2020 against one of the other quarters in 2020. Now, what I think is interesting is if you were in operation as of February 15th, that it doesn't necessarily mean that you were in operation for the full first quarter of 2020. So you're probably going to have to prorate that calculation a little bit. And they're probably going to issue us a little more guidance on that. So I'm not even going to try to explain how we're going to do that calculation. So I want to mention,
Jackie, before we jump into this, was there an opportunity to elect where you can look at your full year reduction versus full year 2020 versus full year 2019?
Yes, sorry. So under the regulations that were issued, if you were in operation for all of 2019, you can compare the entire year of 2019 gross profits against your 2020 year of gross profits and also get to that 25% reduction as well that way. So you don't have to do it quarter by quarter if you were in operation for all of 2019 and 2020. So.
And I think that I picked that up and thinking that was a good opportunity for those small businesses that are not quite diligent in their bookkeeping. So sometimes for them to pull their quarterly financials is very challenging. They may only sit down and do this thing twice a year or once a year. And so it was nice to see the ability to do that. Particularly, I'm thinking about a lot of our realtor clients who may, they do have their quarterly commission statements, but sometimes it's easier to be able to pull this together on an annual basis. So
absolutely, absolutely. And they, under the act, for purposes of, we're going to get to this later, but for purposes of calculating your maximum loan amount, I also would encourage people to use their either 2019 or 2020 to measure that maximum loan amount, because you can use your final year payroll returns and tax returns and things like that. It just makes it more clean and easy. So I totally agree with that. Real fast, we mentioned in the previous slide that the 25% reduction is measured by gross receipts, and the regulations give you a nice long definition of what that means, and I've included it in the slides, but I'm not going to go through it. It essentially just means revenue from any source reduced by returns and allowances, but it specifically excludes any forgiven first draw PPP loan. So what this means is, if you are trying to decide which quarter you're pulling from to reach this 25% threshold, you need to be cognizant of whether or not you've received forgiveness. If you have received forgiveness, that's not going to be included in your gross receipts. If you have not received forgiveness, or at least full forgiveness, that will be included in your gross receipts to the extent that forgiveness was not granted. So you need to keep that in mind. That might dictate which quarter you pull from. And it might also dictate that you hurry up and file your forgiveness form so you can move on to the second draw.
I also want to jump in here real quick to say that when we're looking at gross receipts, they're being very specific about using the same method of accounting that you have used before. So you can switch between cash and accrual to see, oh yeah, I used to use accrual method, and so my gross receipts were X, and now if I use cash method, I'm definitely going to be, more than 25% reduction. You have to stick to the same method of accounting. So it's got to be apples to apples, essentially.
Right, right. And I would, if you're going to take this loan, if you all at the end of this webinar, you think, yes, I might be eligible for this second draw, you do want to go back with your professionals and take a close look at the rules and requirements, not only in my slides, because this is not comprehensive, but the regulations and the new law altogether, because it is so dense that if you don't take a close look, you can miss one of the requirements or exceptions. It's just ridiculous.
And by the time you're done reading the regulations, you will not even care if you get a loan.
Exactly. I'd rather not take the loan.
I'd rather close my business.
I really wanted to abandon my law license when I started reading through this stuff. I'm like, this isn't worth it. So there are certain folks that are not eligible for a second draw loan that they list out with specificity. One of these has been talked about quite a bit that you may have heard about. Number one, you have to have been eligible under the economic aid for your first draw. You can't be involved in political activities. You can't be owned by 20% or more by an entity organized under China or Hong Kong, nor can you have a member of your board of directors be an individual resident of China. Now, what I will say about that is they're going to come out with additional guidance, which we're going to bore you with in the future. But I will mention that the member of board of directors, that's akin to a corporation. They don't really touch on managers of an LLC, but there's a lot of large LLCs out there that have managers that control a lot of the operations. So I have a feeling they're going to extend that to managers of LLCs as well. Also, there's foreign agents. That's not going to apply to anyone. And certain other recipients of shuttered venue operators, people that are owned, or entities that are owned by certain members of the executive branch in Congress, anyone who lists their shares on the stock exchange, any entity who previously received a second draw PPP loan, and any entity that has permanently closed. That's one of the new criteria that came down through the act. They were very careful to list out as to first draw PPP loans and second that this loan is not appropriate and will not be authorized even after it's received if you permanently close your doors. So keep that in mind as well. Now, if you're temporarily closed, that's a different story. So if you come in and you use the loan to keep your employees employed during the covered period, but then after you run through your PPP loans, you ultimately have to close your doors temporarily until circumstances change, that in and of itself will not disqualify you. I also want to mention that the certifications that are going to be required under the second draw loan are going to match the first draw loan with some additions. So one of the ones I really want to mention is the necessity certification, because that is going to be one that even if you satisfy all of the requirements to receive the second draw loan, you have less than 300 employees, you can show you had the 25% reduction, you still need to get over this hurdle, which I think is going to be challenging for a lot of borrowers. Number one, we don't have a lot of economic uncertainty, or at least that's diminished a great deal since last spring. So you really need to focus on the necessity and whether or not the loan is needed to support your ongoing operations. And I've heard a couple of other practitioners use a good rule of thumb that I completely agree with. Unless you have legitimate concerns about whether or not you're going to be able to continue to maintain your payroll and make payroll in the future, I don't really feel like you qualify for the second draw of the loan. So keep in mind, satisfying the other criteria is one hurdle. This is the second hurdle, and you need to take a close look at it, because not only in the act, but also in the regulations, they're really beating us over the head with warnings about the penalties, the charges and the fines that can be assessed if you make this certification and it's actually not true. So,
and we saw a lot of that after the first PPP, and then there was all that pressure on some of the larger companies to return the money, and some educational institutions. And so it's not surprising that they put a big hammer in the middle about that, so that way nobody could say, well, I didn't know. Well,
exactly.
The way everything unrolled the first time, I get why you didn't know. Now there's no reason you don't know.
Right.
We do have a question, Jackie, that says, would a company which started operations in 2020 and has losses and payroll qualify for the second round if they don't have that 2019 or quarter-over-quarter comparison?
When did they begin operations?
Just says in 2020.
If you began operations, if you were in operation as of February 15th of 2020, then you're going to need to look at that first quarter and what you made in that first quarter of 2020 and compare it to one of the other 3 quarters of 2020 in order to achieve that 25% reduction.
Okay,
so
they began in January.
Yeah, so yeah, that's what I would look at. I would compare 2020 quarter 1 against quarter 2, quarter 3, or quarter 4 to see if you can achieve that 25% gross receipt reduction.
Okay, thank you.
And this is the scary language I was referring to. I'm not going to read it, but you can see they're really trying to hammer this in about what can happen if you make a false certification. And I'm going to touch on this later. This also extends to if you misuse your loan funds. So keep that in mind as well. The maximum loan amount for a second draw loan is going to be the lesser of $2 million, or 2.5 times the applicant's average monthly payroll. So that's going to include not only payroll that you pay to your employees, but if you're self-employed, if you're like a general partner, or if you are a Schedule C filer, that's going to include your net self-employment income averaged out by dividing it by 12 multiplied by 2.5. Now, if you are fortunate enough to be in the hotel or food industry, you may actually be able to qualify for a 3.5 multiplier. So you'll actually qualify for an even larger loan. But you have to have, it's an NAICS code, which you can find online. Your CPA should be able to tell you what code is assigned to your business based on the nature of your business. But it has to begin with 72. But 72 is pretty broad, and it basically encompasses restaurants and hotels. So as long as you have that code assigned to your business, then you may, if you otherwise qualify for this, you may qualify for the 3.5 multiplier, which will get you a larger loan, which is nice. So keep in mind, though, also, if you are a Schedule C filer, I include a little more detail here and here for partnerships and Schedule C filers to go back and take a closer look at exactly the calculation you use to get to your loan amount. But it's basically going to be the monthly average of your net income as determined by your K1 or by your Schedule C. Now, if you're using, depending on what year you're going to use to calculate this, let's say you want to use 2020. If you haven't prepared your tax returns yet, you're still going to need to calculate this and put together a draft return which first-time PPP borrowers know what we're talking about because you had to do that previously. So you're going to have to still prepare the return and show what it will look like once you do file it. Now, the period that you can choose from is either going to be 2020 or 2019 for all borrowers, or if you're not a seasonal employer, a Schedule C filer, you can also use the 1 year period before the loan is made. But like we were saying earlier on, for purposes of calculation and making this an easy exercise, I would recommend just using 2019 or 2020 because it's just going to be a lot easier than using the 1 year period before you receive the loan. Also, seasonal employers, you receive some reprieve under the Act. The time frame that you can pluck from to determine your maximum loan, it can be any 12-week period between February 15th and February 15th of 2019 and February 15th of 2020. So that's much more broad than what was previously provided under the Act. So this is one of the new rules that came through under the new Act that might allow you to increase your first PPP loan. So if you got a PPP loan based on one of the other periods that was previously authorized, and you, under the new rules, could receive a larger first PPP loan, that does give you the basis to go back and request an increase of your first PPP loan. So just take a look at the, the expanded time period and see if that helps you at all.
Quick question on that for clarification. Do you have to use February 15th of 19 to February 15th of 2020, or is it the whole year of 19 and the whole year of 20 when you're doing that comparison on the payroll?
So for a seasonal employer, it has to be a 12-week period falling between February 15th, 2019 to February 15th of 2020. So you can't use 2019 or 2020 if you're a seasonal employer. You have to use that exact 365-day period.
But if you're not seasonal, you can use the whole year?
Yes.
Perfect.
If you're not seasonal, you can use 2020, 2019, and as long as you're not a Schedule C filer or a seasonal employer, you can also use the 365 days immediately before applying for the loan as well.
Perfect.
All right, we've covered that. Payroll costs, since the maximum loan amount is determined by payroll costs, I kind of just want to go back over what those mean. That's going to be compensation to your employees, which includes just normal wages, commissions, tips, pay for vacation or family or medical sick leave, severance, group benefits such as health insurance, dental, vision, and then if you're an independent contractor or Schedule C filer, that's going to include your commissions, income or net earnings from self-employment. What's excluded from payroll costs is going to be those FICA taxes. And also if you, and I want to clarify this point because I do think there's some confusion around this, there are certain wages under the Families First Act that are entitled to a credit because the employers are required to cover those wages for employees or parents who have to take off of work because they either get COVID or one of their family members gets COVID. So under the Act, there's certain protective provisions, and due to these protective provisions in favor of those folks, there's a certain tax credit that has to be granted. Now, you don't have to take advantage of that tax credit, but those wages which you are required to pay cannot be included in your payroll costs for purposes of calculating the maximum loan amount. So I just want to mention that even if you don't take advantage of that tax credit, you still have to discount that from your payroll costs. Documentation that you have to submit with the application, it's going to look similar to what was submitted with the first round of applications. Basically, the tax forms and payroll information that's going to document the amount that you're claiming. So your 941s, your state quarterly returns, payroll processing records. If you are a partnership, your K1s. If you are a Schedule C filer, you're going to need to include your Form 1040 Schedule C. There's also going to be documentation that is required to substantiate that you were in operation as of February 15th, 2021. They don't give us a lot of details about that. They're pretty vague, and they basically just say bank statements, books of record that establish that the applicant was in operation. So, whatever you can basically cobble together to show that you're actually functioning as a business and operating at that point in time. Now, I don't believe that that was included previously in the prior acts. I think that's relatively new. So there probably will be some additional guidance that will come down to further clarify how you can meet that requirement. And I also just want to mention that if you're taking a second draw loan and you're supplying this documentation to the same lender and you're using 2019, so you've already supplied a large amount of this documentation to your lender for the first PPP loan, you don't have to supply it again. They should have it in their file, so you don't have to go through your paces again to resupply that information. Now, if your second draw loan is $150,000 or more, you are going to have to supply with your loan application documentation that substantiates that 25% reduction. However, if your loan is $150,000 or less, you don't have to supply it with the loan application itself, but you are going to have to supply that documentation before you supply your forgiveness application. If you elect not to pursue forgiveness, that doesn't get you off the hook. You're still going to have to be prepared to submit that documentation to SBA if they request it. Like I mentioned before, there are some first draw PPP borrowers who are being questioned by SBA with respect to their loan for a number of reasons, not just the necessity requirement, but how they calculated their loan and a number of other different things. If you are being reviewed with respect to your first PPP loan, that does not mean that you can't submit an application for a second draw loan, but what it does mean is it won't be funded until the unresolved issues are resolved by SBA and your lender and yourself. So SBA is gonna flag your second draw PPP loan application, and they're not gonna issue the SBA loan number until it is resolved. So just be prepared for some delays, but I don't think that means that there's any reason why you shouldn't start preparing to submit for the second draw application if you qualify. Also, we're gonna dive into the forgiveness aspect of the second draw loans in more detail in the future. The regulations have promised that there's going to be more guidance and regulations issued with respect to forgiveness, which we're really excited about. And it's going to be a mouthful again, but we'll get into that and we'll address the regulations as they come out and the guidance as it comes out. And we'll probably also refresh everyone's memory about the different exemptions that apply to reduction of headcounts and salaries and things like that, because there is a lot to weigh and consider. But in general, just to touch on this briefly, the second draw loans are eligible for forgiveness, assuming that you use the proceeds for forgivable purposes and you generally maintain the employee headcount and the compensation levels. You do have to use the proceeds within the new covered period, which I'm happy to report has been relaxed quite a bit. So under the prior act, the covered period was either 8 weeks or 24 weeks. You had to pick one or the other. But now the covered period is going to be anywhere between 8 weeks and 24 weeks at the election of the borrower. So your covered period begins when you receive the loan proceeds the day that the loan is funded, and then it can expire as early as 8 weeks or as late as 24 weeks, and you as the borrower get to elect that date. So if you have concerns about your employee headcount or reduction of wages or anything like that, you have the discretion to kind of pick the expiration of your covered period between that 8 week and 24 week period, which is really going to benefit a lot of second draw borrowers. Another really positive thing that came out of this new act is that EIDL grants no longer reduce the forgiveness. So when we were going over forgiveness applications and the terms of forgiveness previously last year, we hammered into everyone that unfortunately the EIDL grant that you received anywhere between $1,000 and $10,000 is going to reduce your forgiveness off the top. So that is no longer the case, thankfully. And there's even there's some provisions that for folks that have a first draw PPP loan for which they've already received forgiveness, which means they've already incorporated that reduction of the EIDL grant, you actually can go back and request that this be adjusted after the fact in order for you to not have that reduction of forgiveness that was used against you whenever you filed your application for forgiveness. So you can take advantage of that even if you have filed your forgiveness application and received forgiveness. So that's great news.
It's amazing to me how much time we spend figuring out how that idle grant reduces the forgiveness. And we went through the formulas and the application samples and tried to wrap our head around it just to come to this point where it doesn't
It didn't
really
even
matter.
matter. It was infuriating to me when I was reading everything. That was the first thing that I was like, you got to be kidding me. And
Yep.
remember when we told everybody, just be patient, wait, things will change. Nobody wants to be patient.
Mhm.
Things change. And it's hard when you're in that, especially in the first round when there was way more uncertainty about what this would mean for companies. And not that there aren't still businesses struggling. I don't mean to intimate that this has disappeared, but we have our arms around this much better at this juncture than we did then. And it was scary on top of frustrating, and that's a dangerous combination.
Yeah, exactly. And it is more of a known animal now. And I feel like it just makes people a little more comfortable when making these kinds of decisions for their businesses. Because, you know, everybody was saying, wait for this short form, wait for this, for the additional guidance and the additional regulations. But on the flip side of things, practitioners were also warning you that the changes could not benefit you. So hurry up and get your application in for forgiveness in case the new laws are not beneficial to you. So it's really a catch-22, and hindsight is 20/20. And it is frustrating reading these changes and saying, gosh, if you could have only made these back in May, it would have saved me 15 business days of discussion and reading. But it is what it is. Onward and upward. So another really positive thing that came out of the new legislation is the permitted uses of PPP loan proceeds. I'm going to get to that on the next slide. I'm going to kind of refresh everyone's memory about what was existing as a permitted use of funds under the old act, and then we'll move into the new uses. So payroll costs, first and foremost, keep in mind, this is something else that was really hammered in the new regulations. Payroll costs have to be 60% of what you use your first draw or second draw PPP loan proceeds for. You cannot play with that number. This is not just a limitation on terms of forgiveness. This is a limitation on what you are legally authorized to use those funds for. So keep that in mind. Regardless of whether or not you care about seeking forgiveness, you need to make sure you're using at least 60% of the loan proceeds for permitted payroll costs. The balance can be used for mortgage interest payments, rent payments, utility, interest payments on other debt obligations incurred before February 15th. Also, if you're refinancing an idle loan made between January 31st and April 3rd, keep in mind, if you got an idle loan that was used for purposes other than payroll, you don't necessarily have to refinance it. So keep that in mind. They make specific reference to that in the regulations, and I think that's to let borrowers know that you don't necessarily have to refinance your idle loan. That's only if it was used for payroll costs. Now, the new expenditures, which I think are really helpful to a lot of borrowers, these can be covered with that remaining 40% of your loan proceeds. The first one is covered operations expenditures. This, the way I read it, is mainly software and cloud-based programs that help manage your payroll, billing, accounting, tracking of supplies and records and expenses. I don't think that this extends to necessarily payments that you would make to, say, a third party who manages these things for you. Think of like ADP or your independent contractor bookkeeper. You can cover the expenses of the software that they use, that you maintain in-house, that they utilize to track and manage those things. But I don't think their payments or what you pay them on a contractual basis is going to be covered by this. Now, they could come out with additional guidance that completely contradicts what I'm saying right now, but based on how I'm reading it, I believe that this is what is actually covered. Also, covered property damage. If your business was damaged by looting or riots in 2020 and the expenses were not otherwise covered by insurance or other compensation, you can use that 40% portion of your PPP loan to cover those damages and costs. Supplier costs. This is going to be for anyone who has a supplier contract, who places orders or contracts for certain supplies. But the caveat here is the contract or the order has to be placed before you receive the loan, unless they're perishable goods, in which case the order would have to be placed within your covered period. If it's not perishable though, they want to make sure that the order is placed before you actually receive your loan, because what they don't want is you placing orders for supplies once you receive your loan and you're trying to find a way to spend your PPP proceeds. They really only want this to be covered if it's something that you would otherwise incur in the normal operation of your business. So if you're a builder and you have a contract for a new home or a new building that you're building, if you placed orders for certain supplies prior to receiving your second draw PPP loan, that should be covered. If you place the order for the supplies after you receive your PPP loan proceeds, that's probably not going to be covered. And that's not going to be permitted to be used. So it needs to be essential to the current operations of your business. Covered worker protection expenditures. The regulations did a really good job of offering a lot of examples of what this means, which I've included in the slide, so you can refer back to this after the webinar. But it's basically going to be any measures you took and additional supplies or capital equipment that you acquired pursuant to requirements and recommendations issued by the Department of Health and the CDC. So if you think about, the partitions that are up everywhere, the additional space that has been used by restaurants to expand their dining spaces, and even ventilation systems if required, and also think about, the additional provisions of taking your temperature whenever you're dropping your kid off at preschool and the separate stations that are all set up, things like that. Those are expenses that these businesses had to incur, unfortunately, and the government basically wanted to cover those expenses to the greatest extent possible. So those are included here as well, which I think is really nice. Something else I want to mention real fast is that this expansion of permitted expenses applies to PPP loans issued before and after the recent act. So even if you've already spent your PPP proceeds, but you haven't applied for forgiveness yet, if you utilized your PPP proceeds for any of these items, or if you utilized any proceeds for any of those items, I should say, you can, essentially try to lump them into your forgivable amount to the extent that they qualify for one of these additional expenses that we've described here. So just because you've already received the loan or spent the loan, that doesn't mean that you can't take advantage of this recent expansion to what are permitted expenses. Back to the warnings that the regulations were providing, they again really reiterated more than once in the regulations that you cannot use the PPP funds for anything that is not authorized, as I just described. And they go as far as describing exactly what might happen if you use them for unauthorized purposes. They include the fact that not only will they not be forgivable, but they'll have to be repaid. If you knowingly use the funds for unauthorized purposes, you can be subject to the liability that I described in the earlier slide, which is a number of different federal charges and fines for things such as fraud. And also something they mention is that if one of your shareholders or partners or members, if you're an LLC, uses the funds for unauthorized purposes, they can go after them personally. So a lot of folks believe that, they're under that protective corporate veil of their corporation or their LLC, and that they won't get spanked for liability, only their entity will, but that's not actually the case. The law that was passed down recently specifically goes above the corporate veil and says that they can come after you personally. So just keep that in mind. And another thing that Marina and I have discussed and that a lot of practitioners are warning clients about is under the new act, they have really afforded the lenders a lot of protection in terms of basically indemnifying them in the absence of fraud or violation of other federal acts. So your lender is not going to be watching your back. They're going to be watching their wallet, and the more loans they pump out, the more money they make. So they're not in a position where they have to coach you or even verify that what you're including on your loan application is accurate and correct. So I can't urge you enough to, if you do think that you qualify for the second draw loan, to make sure you're talking to your professional advisors, not your loan officer, about whether or not you truly qualify for this loan, because the lender is not in a position to guide you on that. And And even if they say, yeah, it looks good, you probably should qualify. If they're wrong, you're the one that's going to get tagged with the liability, not the loan officer and not the lender, because they're actually indemnified from that. So please keep that in mind. Marina and Joanne, do you agree? Have you heard those warnings as well?
All I've heard is lenders going, don't ask me anything.
Well, good, and good for them. They should be saying that.
I feel like at the beginning, they were not sure what their responsibility was. So they were a lot more diligent about asking for things and, figuring out to make a decision. But once they figured out that they were indemnified, and I feel like that guidance came out a little bit later to say specifically that the bank is not going to be responsible for any mistakes on the application, for the amount that was given in error or something like that. Then the banks were like, hands up. And, I feel like talking to some of these loan officers through the first round of applications, they were diligent because they were working with their client. And it was really nice to see that, especially when there was a relationship with the client and the bank, that the banker did go above and beyond and really try for this client to get the loan. And but the banker is getting the documents for the loan. They're not working with the client to really figure out what is the correct payroll amount and what was your financial statement. And especially now when we have this requirement about the decrease in gross receipts, I don't think you want to be relying on them to advise you to look at your financials and to say, did I have the decrease or not? That the banker is not going to see that. And so I think that is definitely on you to make sure that you work with your bookkeeper, your tax advisor, your attorney, to see if you even apply for this loan and then deal with the banker later.
In fairness to the banker, they're trying to keep their internal operations under wraps. That's not, I hate to say it's not their job, but we're confused as lawyers and CPAs and professionals who read things like this all the time. When you talk about the banks throwing together folks who have come from different departments to try to put all hands on deck to help, these are people who maybe have never even done business lending before. They've pulled folks from residential lending. They've pulled folks from different operational branches of the bank. And so they're trying to help, but they're not experts in this area by any stretch, simply to try to cover the volume. So the bank is probably, unfortunately, the least reliable source for any kind of questions when it comes to that.
Mm-hmm. Exactly. And they may be well-meaning and trying to help, but just, keep in mind, you want to double check these program requirements with your attorney or CPA, and just to be sure. And I wanted to also mention the lenders should be coming out with these with the one-page forgiveness applications fairly soon. I checked this morning and I haven't seen it posted yet. I don't think you guys have either, right?
No.
So it hasn't come out yet, but there's a certain statutory period that they're required to release this because they aren't already under enough pressure. So that should be coming out very soon.
Let's do something really difficult and unwieldy, and let's hurry and do it. That's a recipe for success.
I feel I saw the date of January 20th, if I'm not mistaken.
That makes sense. Mm-hmm. That makes sense because it was 27 days after the passage of the act, but I didn't feel like going and doing that math. You're the CPAs.
Yeah. Like nothing will be going on inauguration day. We should be doing this.
Yeah.
Oh my gosh.
Because the political climate is so calm.
And that's why this is the reason too why we encourage a lot of our clients to wait for the forgiveness application. In fact, as Jackie were talking, we were looking at some of the questions, and there were a couple of questions flying through about should I go ahead and submit the application for forgiveness. And to be honest with you, if you're already in the middle of the application and you've got all your ducks in a row and all the documents, sure. But with the simplified application form coming for the $150,000 and less loans, I would just wait, because I feel like just from the general description of it, I feel like there wasn't a whole lot of documents you had to attach to that. And so it may just be an easier application to fill out in terms of the backup. Again, you still need to have all your backup of how you got to this forgiveness, but a lot of it is going to be the certifications to say, I swear I used the loan correctly. I swear this were my expenses. And, perjury and all of that scary stuff. But I think that the ones that who have already pulled their stuff together, there is no really reason to wait. I don't have a whole lot of clients who have applied for forgiveness, to be honest with you. The few clients that we do have that applied have all gotten forgiveness. So I feel like they were fairly diligent about the application process and everything. So I haven't had anybody who applied and got denied, for example. Some are kind of in various stages of the application, but definitely all of them who have applied gotten forgiveness. And it was fairly quick on the turnaround time. I feel like it was maybe several weeks, if that is correct.
Yeah, I've heard like 30 days. It was a lot quicker than I expected, because you have to keep in mind you're submitting it to your lender, then they have to ship that off to SBA, then SBA has to come back and approve it. So that's pretty quick for anything involving SBA.
I have one manufacturing client who submitted the request for forgiveness, was approved in about that 30-day time frame. That approval came, I want to say, in late October, early November, and it's still not zeroed out on their bank information. So like when they log into online banking, it still shows that that loan amount is outstanding. No payments due, of course, but it hasn't made it all the way to the finish line with the bank yet. So that's, of course, giving them some agita, but you know, they've gotten the formal forgiveness approval, but it's still showing as a loan due in the bank portal. So don't be surprised if any of this stuff moves a little sluggishly, because the banks are they're still trying to figure out forgiveness, which we were talking about last summer. So they're a solid 7 months behind us.
And anything you know about forgiveness, just get ready, because they're going to release another Bible-sized regulation that I get to enjoy. And then we're going to have another webinar where I, vomit.
Jackie's position will be available soon for anyone who would like it.
And people are asking all the time, what is the deadline for, am I going to miss the deadline if I don't apply for forgiveness? And essentially, there's really no deadline to submit the application. We know that you have 10 months from the time your loan period ends to when it actually becomes a loan. So you really have 10 months to submit your forgiveness application. And the funny thing about that is that if you chose your loan period to be the 24 weeks versus 8 weeks, there's really nowhere that you indicate that now you're in 24-week period as opposed to 8 weeks. So essentially you've got if you choose for your loan to be 24 weeks, from the end of the 24 weeks, you've got 10 months to apply for the forgiveness. I can see that a lot of the clients are going to start to get hassled now, like, hey, your loan is due. Meanwhile, they may still be ending their loan period, which for a lot of people who got their loans, if we're looking at that math, people who got their loans in April, May, the 24-week was really over in like November, December timeframe, right? That's the 6 months period. So that's where, around November, December, we were getting a lot of emails and questions from clients on, oh my God, my loan period is over, I need to submit. Well, if they were originally thought to be in the 8-week loan period, then I feel like their 10 months is going to come faster than. So I can see another wave of these questions on, oh my God, my loan is due, and no, it's not, because your loan period was actually 24 weeks, which ended November 8th, and so you still have a whole lot of time before September to apply. So I see it. My crystal ball is clear on that one.
It's Miss Cleo, Marina.
Yeah.
But just make sure though, when you're kind of gauging when you want to submit that forgiveness application, if you do elect the 24-week, just make sure that there haven't been any reductions in your headcount or your pay to your employees that might otherwise ding your forgiveness. So kind of keep that in mind as well. And they're going to be coming out with more guidance, and I think we're going to have to just, unfortunately for everyone, rehash the forgiveness rules, because there's going to be new forgiveness rules and they're going to have to hold into the old ones, and then we're going to have to go over the safe harbors and exemptions, and that in and of itself is like 2 webinars. And
we'll turn it into 3.
But what I will say is there's a lot of information in these slides, not nearly as much that's actually in the act and the regulations, but I know we kind of blew through this pretty quickly and on a high level because we couldn't get down to a granular level because we don't have enough hours in the day at this point. But you can always come to us, after the webinar with emails with your particular questions that pertain to you to kind of determine whether or not you feel like you're going to qualify for this second draw.
Perfect. And for forgiveness, we do have a couple forgiveness questions. Do you want to hold those until the forgiveness webinar?
Let's hear what they are, and then I'll decide if I feel comfortable answering.
So we have, for forgiveness on either the first or second round, is it better to simply choose the 24-week period and use only payroll costs as the 100% of the loan, as opposed to using payroll, rent, utilities, and using the 8 weeks and having a broader variety of expenses?
Well, I mean, first of all, like Marina said, you can always wait and see what happens between week 8 and week 24. If you have a reduction in payroll or a reduction in your employee headcount, that might incentivize you to shorten your covered period. But if you maintain the same 3 employees at the same pay rate for all 24 weeks, and you utilize 100% of your PPP proceeds on their payroll and other the other covered expenses that fall under payroll costs, then I don't see any reason why you can't utilize that full 24-week covered period for payroll costs. Just as long as you're using 100% of the loan proceeds for at least 60% for the covered payroll costs and no more than 40% of the covered non-payroll costs that we went through, then you're fine.
Perfect. Thank you so much, Jack. As always, we are doing our best to bring you the topics that you'd like to hear the most about. So our contact details are here if you'd like to hear about any other types of topics, be they real estate or business or tax related. We welcome your input and feedback on what you'd like to hear about. We will continue to bring you additional pop-up webinars on PPP and forgiveness and the tax update, and all those things are coming your way. We also will continue with our regularly scheduled Tuesday webinars at 10 a.m. Next Tuesday, we will be reviewing a market update so we can see what's happened in 2020 in a summary from the financial markets, and also have a little peek into what we think might be to come for 2021. We hope that this was helpful, and like we said, it'll be recorded and available, so if you have any questions, you can just rewatch or let us know. Have a great weekend. We'll see you on Tuesday.
Thank you.
Bye. Have a good week.